Hi, everyone who's joining us. I'm conscious of time and that we're all here for a lunch and learn, so I'm going to get started. I just want to say a few words. For those of you who don't know, my name is Erin Hallett and I'm Head of Alumni Relations at the Business School. We're delighted to have so many students and alumni joining us from all over the world today. And if you feel like it would be great to say hello in the chat and tell us where you're from. So we have an incredible alumni community made up of 21,000 individuals around the world. And over the past 16 challenging months, our alumni have really supported the business school with over 2,000 volunteer hours. Everything from writing blogs to hosting virtual panels with students to interviewing potential MBA candidates. Thank you so much. And the reason we're all here today is because one of these fantastic volunteers and MBA graduates, Jack Mulcahy. Thank you, Jack, for all that you do to keep our community connected. You've been a big part of our success this past year. Before I hand over to Jack, I just want to remind you that the event is being recorded and the recording will be shared later this week. There'll also be time for Q&A following the presentations, and feel free to type questions into the chat. As you all know as well, we hope to have 3 panelists, but unfortunately Nadine had to withdraw at the last moment for personal reasons. She sends her regrets and she's sorry to miss the event. Her email has been shared for any questions you may want to ask her directly. And generally we like to have a little more diversity on the panel, so we do apologize about that. Finally, I want to say a huge thank you to my team, and particularly Kim Foxwell, for putting this event together. They have all shown tremendous resilience and positivity this past year, and I'm really grateful. And now over to Jack.
Thank you, Erin, and thank you to Kim and the team for putting this together. I won't only speak for a second on this because the real interesting people are going to be Conor and Shahryar speaking about their journey. You know, lots of us are interested in the VC space, the startup space. We read books, we look at blogs, we try to find out as much information as we can. But it really is best, I think, to sit down with founders, quiz them, find out about their journey, find out about their story, why they chose a particular idea over another, how they got funding, what mistakes they made, and probably most importantly, what advice they would give to budding startup founders like ourselves. So without much ado, I want to introduce Shahryar. Shahryar was on the Weekend MBA, and he's going to discuss Capital Pilot, what they do, the business, and hopefully give us some advice to founders as well. So I'll hand it over straight to Shahryar, and then Conor is our next speaker. But Shahryar first.
Okay, I'm muting myself first. Thank you, Jack. I'm just gonna share my presentation. Okay, hi everyone. Really pleased to be here. My name is Shahryar, as was mentioned. I'm an alumni of Imperial Business School. I'm actually a 3-time alumnus of Imperial, and latest degree was Weekend MBA 2019. I also did my MSc in Metals and Energy Finance in 2008, and biomedical engineering in 2003. Started in 2003. So for some reason, I just keep coming back to Imperial. Just can't get enough of this place. Anyways, enough about me. Let's talk a little bit about Capital Pilot, what we do, and then we'll get to the insights and everything that Jack mentioned as well. So we are the Investability rating agency for startups. And what it effectively means is that we've created a rating system using analytics, human power, and algorithms to provide comprehensive assessments of investability, looking into typical criteria and areas that investors look for in early stage investment opportunities, quantifying all of the inputs and outputs, and generating a rating which actually correlates very strongly with the fundraising success of the companies. But more importantly, we provide lots of feedback to founders as well to help them understand their strengths, weaknesses, and any analysis, suggestions, actionable feedback that we can provide to them to help them get into the best possible shape for their fundraising. So as you can see, at the core of our proposition is this assessment and rating, which is primarily designed for founders, but we also provide that to venture capitals, accelerators, and any startup support organizations who wants to use the rating for their own purposes. Think of us as the Experian for startups, basically. We also have a network of investors and access to a whole of market investor databases where we can match companies based on their criteria and provide them with a list of best fit investors based on the data that we've captured on the back of the rating. And where appropriate, we also make introductions to the investors, typically early stage VC funds and angel networks that we have a relationship with. But everything revolves around the rating. We also have relatively recently embedded an entrepreneurial behavioral test or a psychometric test to measure entrepreneurial attributes. It's licensed from a company called Meta, which is affiliated with UCL University, and we're starting to collect data on individual founders as well. And over time, we'll be able to correlate that with the overall investability rating and hopefully generate some really interesting insights on those aspects as well. Soon we're going to launch our own fund vehicle as well, which we're going to call Capital Pilot Boost Fund. And this will be a novel proprietary early stage fund, which will invest purely based on the rating that we generate. It's going to be high volume, high speed, efficient, and bias-free objective because it's using a standardized and systematic rating system instead of the human. So hopefully it will not be subject to the usual human biases that exist in early stage investing. Now, a little bit about how this assessment and rating actually works. We look at 4 key areas, and there are, that, as you can see, market, opportunity, scalability, and executability. Market is anything ranging from the attractiveness of the company's target market in terms of the size, growth potential, all the way to the accessibility of the market, how sustainable the market is over time, and competition and other threats in the market, which will be taken into account. The business opportunity is mostly about the robustness of the business model. We look at the customer, the value proposition for the customer. We look at the attractiveness and sustainability of pricing strategy, branding, messaging, and any other related factors. Scalability is, generally speaking, about how scalable the business model is, whether there is operational leverage in the business model, i.e. revenues growing faster than cost. And we look at tractions, momentum, etc., etc. Executability is mainly about the team evaluating the skills and the execution ability of the team at the helm, the core team. We look at the quality and the completeness of the investor presentation, the financial projections, and anything which gives us some evidence about the credibility of the team and the underlying assumptions behind their revenue, cost projections, etc. We go deeper than that. So there are, as you can see, there are various different granular areas that we also look at. I mean, I probably mentioned most of them as I was explaining the 4 categories, but again, you can see the details of it, how everything is evaluated. We look into details of each of these components, and the outcome will be a report which generates an investability rating, as well as the subcategory scores as well. In our full assessment, we generate a rather comprehensive 24-page assessment report, which you can see some screenshots of. There are actually humans who conduct the assessment. So it's part human, part data-driven. Increasingly, we're getting more and more data into the game, but we're still very much human-driven. So we have a team of trained, seasoned assessors who conduct the assessment as well. So there will also be some written analysis, as you can see the highlights on each section. And you can see it'll be some feedback suggestions as well on each of these categories. And you can see there's a wealth of information about each of these underlying areas that we assess. So a lot of material for the founders to learn from, to digest, and hopefully use to improve their investor proposition. Just a few stats on our rating. I mean, the rating system is very selective. Not that many companies will manage to get the top tier rating, 800 plus or 700 plus. There is also the good number of companies who typically land in the middle, 600 to 700s, which have fixable flaws. And with our assessments, we help them highlight their weaknesses to them, and with fixing those flaws, they can easily get themselves into. I'm saying easily, but not always the case. But they can get themselves into the investable rating thresholds and hopefully improve their chances. We're continuing doing some analysis on the outcomes. Almost 100% of the companies who received a rating above 800 have gone on to raise their funding, and that number drops in line with ratings, but it's still very decent evidence that this rating actually means something. It actually can be interpreted as an investment signal. We've done well over 1,000 ratings since inception of the business, and we have identified a number of areas which we commonly see as areas of weakness in the startups that we rate. I'm just going to touch on some of those and also provide you guys with some hints and tips based on our data on how you can improve some of these or address some of these, or general hints about how to get yourself into better shape if you are a founder of a business or considering starting your own business. So articulation of investor proposition has been one of the most common areas of weakness. Oftentimes founders forget that when they put together the pitch deck, they forget that their audience is actually investors who are looking for a business, not necessarily an idea or a product catalog. Or so it should address their concerns. It should take into account all the risk and reward items that investors will look for. So just make sure you are targeting your investor proposition towards investors. Competitive landscape is one of those easy things that we actually surprisingly we see quite a lot of founders sometimes overlook. You probably shouldn't expect every investor to be an expert in the sector or in the area that your business is operating in. So the more information you provide about the competitive landscape, including the competitors, and highlighting and deriving conclusions about your key competitive advantages, the better. Obviously, investors will do their own due diligence, will do their own research, but in the absence of any information, you probably raise some questions in their heads. Why this information is missing? And they may not have the ultimate expertise in that market to evaluate that as objectively as possible. Proof of market approach strategy is another area. One of the key areas of that is the go-to-market strategy. Identifying your key target audience and identifying channels that you're reaching out to those audience, how you're actually getting access or accessing those clients of yours. And some of these, we're gonna go into a little bit details in the following slides. I'm just gonna give you some headlines. Quality of presentation of traction. Again, traction is one of the most important aspects of business, and traction can mean different things to different stages of business. We'll get back to that in a sec. Startup experience, or more broadly speaking, a team. Having the complete set of skills in the team. And if you have prior startup experience, that's always a bonus because you're already familiar with the key challenges, typical challenges that startup founders will face. Absence of that doesn't necessarily mean that you are not going to become a good founder or make a good business, but having that always helps. And clarity and detailed financial model, which we'll come back to in a second. Now, with that in mind, how can you improve your investability? I mentioned investor proposition. This is actually about presentation and proposition. It's not just about having a pretty presentation. It's about having a strong proposition which complements the presentation, which hopefully should be a crisp and clear presentation with clear messaging in it. So we often talk about the 90 seconds rule. Investors may not spend more than 90 seconds on your pitch deck when it lands on their desk. If they're not able to understand the proposition and the presentation is not clear enough, then the chances are they might gonna pass on this. So it's something to bear in mind, having both a crisp presentation and a strong proposition to complement that. I mean, if you're a founder, if you've been working on your pitch deck, you know there's a set of items that pretty much every investor would like to see. Defining the problem, laying out the opportunity, your solution and your value proposition, what your business model is, how you're actually making money, what the underlying magic is, what's your key competitive advantage, what's the thing that makes you unique. What's your marketing and sales strategy, the go-to-market strategy, how you're actually planning to reach out to your customers. What's your traction? How much demand effectively are you able to generate, potential for demand or actual demand? Who are your competitors and what's the competitive landscape look like? Who's the team behind the business? What are your projections, financial projections, and the key milestones that you're trying to achieve or you have achieved? And what is the ask from the investor? Now, going into a little bit of details of some of those important items. Traction. Traction is sometimes misunderstood. Traction is actually about evidence of real or potential customers. The ideal case for traction is sales, revenue. But in the absence of sales, because we know early stage companies, they're not necessarily revenue generating. Actually, in fact, a lot of the business we assess are pre-revenue. So we're looking for other measures of traction, which could be pre-orders, sign-ups, premium users, registrations, letters of intent, etc. So all of these, depending on the stage you're at, these could be classified as traction. How about these? Awards, mentions in magazines, pitching competitions, well-known advisors. Well, some people confuse them as measures of traction. These are not necessarily tractions because these don't translate into demand. These guys are not going to buy your services. However, these are great validations of credibility of your business. So by all means, you should talk about them. You should mention them and include them in your pitch decks, but don't confuse them with traction, because traction is actually that demand for your solution. Those who are willing to pay for your services, basically. This could be a good gauge of what can be seen as traction based on your stage of development. If you're an early stage B2C business with no product or prototype, maybe sign-ups or pre-orders can be considered as traction. If you're a B2B business, similarly pre-orders or letters of intent, or let's say clinical trials if you are a pharmaceutical business, for example. If you're an early stage app platform or SaaS business, again, number of users, freemium could be freemium users, number of signups or registrations could be good signs of traction. And if you're a later stage business, obviously revenue will be the key traction metric that everyone will look for. Even better if it's profit. Team. Again, team is probably the most important thing that investors look for. You've all heard that probably. It's about the completeness of team expertise and skills. This is how we look at it, and this is how most investors will look at it as well. Investors want to see whether you have the right domain expertise in the team, whether you have the technical expertise, it could be in-house or outsourced, whether you have sales or growth expertise, growing business, and also whether you have prior startup experience, whether as a founder or as a key member or some exposure to startups, because that always provides some edge to the team, as I mentioned earlier. So it's about laying out the competitive edge from the team. And it's absolutely fine if you don't have, at the beginning of your journey, if you don't have all of these skills. It's also about having or acknowledging the gaps in your skill set and having a proper planned team build strategy for future to address those gaps. sometimes advisors can fill in those gaps at the early stages if you don't have necessarily the core team member who can address some of those. Again, some hints on how to provide team information. Make sure job description is clear, prior relevant experiences is there, core team and advisors are included, and more importantly, make sure it's in line or consistent with your LinkedIn or any other social media pages, your website, etc. Because investors will not rely solely on your pitch deck. They'll do their own due diligence. They'll look into different sources and make sure all of these information stack up. And finally, financial model, which is again one of the key areas, not the most decisive one, because we all know financial models are based on projections, which could change overnight with any internal or external event in the business. But it's also, nevertheless, it's something that we cannot get away from as founders. So we still need to show some level of detail and clarity in the financial model. We need to have the revenue build up, the cost and expenses. And cost is pretty much, I mean, there is a finite list of cost items that any startup will incur anyway. So make sure you have details of those, including the headcounts, your kind of hirings, cost over time, etc., which probably will be one of the key components of the cost. You need to have cash flow projections, making sure you have 3 to 5 years of forecast, ideally monthly breakdown. And more importantly, the most important thing about financial model is the credibility and the sensibility of assumptions. That is what will probably, that is what we assess very rigorously. And it's basically shows how realistic your projections are or how much in control of your business you are. If you're not using credible assumptions, there is probably some red flags being raised. So it's all about assumptions, assumptions, and assumptions. And finally, as I mentioned, it's probably the first point that I mentioned, don't forget investors in your presentation, because the investor is actually looking for a business, not an idea or solution. It needs to encompass everything that investor wants to know about your business. Final quick point, as I mentioned, our assessments are primarily conducted by assessors, which we call investability assessors. We're actually looking for investability assessors. This is going to be a flexible role, which enables assessors to help us assess, rate, and analyze startups. And if you're a current or recent master's student, business school student, that are interested in the world of early stage tech or angel or VC investing, this is probably a really good, just definitely, I would say, a good opportunity to get your feet wet. Or if you're an experienced freelancer, consultant, who have worked with startups in the past and are looking for another way to get involved with startups to help founders, again, this is probably one for you. So if you want to learn more about the role, feel free to contact me, Shahryar at capitalpilot.com. We routinely hire students from Imperial and other business schools to help us as investability assessors. Final point, we're also a startup, as you probably have guessed, and we're also raising our own seed fund. And as I mentioned, we're launching our own boost fund, 5 million fund as well. We are more than halfway through with our fundraising. We've received commitments of 300K, but we have a final 200K to fill. So if there is any investors in the room from the Imperial alumni who's interested to get involved, again, feel free to reach out. This is my contact details, Shahryar at capitalpilot.com. Sean will be, he's head of our client ops. And again, if you want to note down these email addresses, we can always answer any questions that you have. And that's it from me. Thank you very much.
Thank you, Shahryar. Just a couple of questions for you. I'm going to ask you one as well.
Sure.
And it's an interesting one. We all have ideas, you know, and they're like, this could work, that could work, you know, and obviously you see very early businesses. What kind of advice would you give to some founders where, no, that idea is not going to work, and kind of get them to assess that idea in their head? Because sometimes founders, the key thing is to be driven and focused. And as you've probably seen with some decks, they should have done some maybe due diligence, or maybe dip their feet in and maybe weighed up the ideas? What kind of advice would you give founders to?
Yeah,
it's a weird way of asking it, that it won't be a success. Maybe it's competitors, it's a very busy space, or there's big, just that kind of it's a kind of a long question, but it's a kind of a tick list for founders, maybe not to press on with the idea. That would be my first question.
Very good question, actually. So the first thing I would advise them to do is to assess whether or not there is actual demand for that particular product or service. Validate it. Before you start building a product or service, you need to validate it in the market. Do lots of research, interview people, survey people, do your market research, size the market, understand. First of all, identify your key target audience and just quantify that number. How many potential customers does it exist in that market? Does it actually make it a worthwhile market to target? But as I said, more importantly, try to validate it. We often call it product market fit. Just go out to market, create the most basic form of your product, even if it's on a piece of paper or on a kind of a not the full application or not full product. Just come up with innovative ways to validate your idea in that market, collect as much feedback as possible. And at the same time, you still need to do your research about competitors and what's lacking in that particular market, what everyone else in the market is doing, what are the key untapped or untouched areas that you can address or you have a competitive advantage to address. So make sure you're actually addressing a real pain point, make sure there is enough demand in the market, and make sure what you're producing as a product or service actually meets the expectations of those who you're targeting. So there will be eventually some people who will pay for the service or product. So these are probably some high-level pointers that I could give to founders as advice.
I'm going to join two questions. Just go a bit back over the ratings that you do, what the metrics, and then what do the startup get kind of out of it? I think you discussed the report, but is it used as an advisory to founders to then tweak their idea or tweak? Just going to talk a little bit about the ratings and talk a little bit about the report.
Sure. So as I mentioned, we look at all these 24 reporting fields under 4 high-level categories. We provide detailed analysis and suggestions on each of those categories, as you can see in the screenshots. So this actually highlights to founders what their strengths are, what their weaknesses are. And we also provide actionable feedback in form of a written suggestions that they can use to make improvements or make changes to that particular area. These could be presentational flaws that we identify, which can be easily fixed, or more fundamental proposition flaws. So remember, it's not only about assessing the pitch deck. We go deeper than that. We look at the underlying proposition as well. So we try to provide some actual feedback on that as well. The founders, the report that the founders receive, they can do one of the following two probably. If they're really serious about the fundraising and close to raising fund, they can use that as an investment signal if they've received a high rating, obviously. So they can use that as a validation of their business. They can use our network to get introductions to investors on the back of it. But even if they're not necessarily looking for immediate fundraising at that moment in time, they can use it to unlock some or discover some insights about the business from the perspective of an investor. We are doing effectively what an investment analyst at a VC does, but we do it in a friendly manner. We try to provide you with lots of feedback on your proposition rather than just saying yes, no. And we try to look at it from the perspective of investors. So when you get in front of an investor, you know exactly what you'll be asked about, what you can talk about, what your strengths and weaknesses are. So again, this can be used as a diagnostic tool for founders to understand the healthiness of their business. or the quality of their business, or it can be used as an investment signal to raise funding on the back of it.
Another question before we go to Conor, and if anyone has any more questions from Shahryar, please come. There'll be questions at the end. Two things that come across is traction is quite important, and obviously team. But I'm going to ask you something on team. Any advice or anything that you've seen on the pitch decks is for co-founders? Is it previous teams work together, or have we seen, you know, founders that went and met at kind of co-founder events? Have you any advice to people here on teams, on creation of teams, or anything that you've seen that has worked?
Yeah. So there is not a single formula for success in terms of the team. Typically when there are co-founders, we've seen kind of bit of more success rather than being a solo founder. So always consider having someone with complementary skills, not someone with identical skills as yourself if you're a founder. So make sure you have a good spread of skills and expertise in the core team, whether it's the co-founders or the key members of the team, the management team, basically. Again, not suggesting that if you're a sole founder or a single founder, you're not going to do well. I mean, that's perfectly fine. It's perfectly acceptable, obviously, as long as you can still show that completeness of expertise in the team. I mentioned 3 or 4 areas that we look at. The domain expertise, which is, for example, if you're a fintech business, for example, do you have the right financial services background? Do you have someone with banking experience, for example, in your team in that particular domain? Do you have the technical expertise? Do you have, if it's a product or an app, do you have an app developer or an in-house CTO or even outsourced tech team? Do you have experience growing business before, whether as I don't know, I mean, it could be in your previous startup experiences or other jobs that you had. I mean, if you have that kind of experience, that's always a plus, because more than anything, being a startup founder is a sales job. And also startup experience. If you have been exposed to startups before in whatever capacity that you can think of, if ideally as a founder or a core team member. Again, these are things that we look at, and make sure when you're forming your teams, make sure to select people who complement you on these skills. Make sure you have the broad range of skills in your team. And even if you don't, that's again fine, because we don't expect the early stage companies with not much funding in place to have all the right team members. You can onboard advisors in those scenarios. You can have advisors, and always, I mean, obviously you can offer equity, stock options to other members of the team. Obviously, if you onboard them at the early stage and you're not in a position to pay them hefty salaries. So these are all also things to consider. But make sure, in brief, make sure you have the collective skills that's needed for your business to succeed. And also another advice is to look at other competitors and peers in the market who are at a later stage, and just to get an idea what a successful team looks like. What is the composition of a successful team? Maybe that could be used as a benchmark as well.
Thank you, Shahryar. Look, if anyone has more questions for Shahryar, please put them in the Q&A. Shahryar, there's also a question in there. You can probably come back to the person with regards pricing, but you can type that back to that person.
Sure.
So for now, I think it's best to bring Conor on board and to introduce his business, Nory AI, if I'm pronouncing it correctly. Why I thought Conor was really interesting as a background was you have Shahryar who's giving you advice on like traction and what people look for. But here also is Conor. He's going to talk about his experience, his business, his investment journey, and his story. So over to you, Conor, and I'll step out.
Thanks, Jack. Delighted to be here, guys. And that was a great presentation from Shahryar. A lot of really good practical inputs there that really benefit you on your journey. So for today, I thought it best, I suppose, considering the audience, to talk through my own fundraising journey. So we just completed our pre-seed round for $2 million in April. We started it in January, and talk about that process. Through trial and error, what was effective, and some kind of practical advice from my side on what will help you. Because I suppose out there online you can find a lot of medium articles, blog posts around VCs, what they look for, some practical stuff. This is a little bit more probably ad hoc, but then at the end of the presentation, I have the actual deck that we use. So you'll be able to see some of the advice Shahryar gave you actually in a live deck that we use to raise our funds as well. So you might just do the 90-second walkthrough at that point and see if we can keep people interested. Cool. So how to run an effective fundraise. Before I get into that, I suppose I'll give you a bit of background on myself. So I was in Imperial, obviously graduated from MSc Economics and Strategy for Business in 2014. I got in straight into finance, as you do. Was working as a quantitative trader and investment strategist for a number of different finance houses in London and Ireland. Really enjoyed that and built up a great skill set around practicalities, what make businesses successful, etc. But decided to leave that in 2018 and start to fry chicken for a living, which is a little bit of a random jump, but set up Mad Egg, which is a fried chicken restaurant group in Ireland. So decided, obviously, at that point, I'd be going to take a much more data-focused approach to running a restaurant to try and beat the kind of failure rates that you see. And from day one, we were doing what was the early inceptions of Nory, which we'll get to now, which was around quantitative modeling performance, kind of a real-time analysis on like sales forecasting, looking to automate where possible so help people make better decisions. Worked pretty well for us. We scaled up to around 6 million revenue in just over a year, about 13 months. Opened a bunch of locations, had pretty good EBITDA relative to the market, around triple the average profitability at 25%. Got a lot of buyout offers. And that was kind of the first step of validation or traction or pull from the market that people wanted a business model or a different approach to running a restaurant chain. So then this led me to last summer, set up Nory. And what we are is looking to be the future of restaurant management. So we're a full stack automation product for restaurant chains. We look after workforce management, inventory management. And what our differentiator is it's completely built on top of our own proprietary AI engine. We plug into a business, we learn the ins and outs of operations, help them make the next best step or next move. So that could be who to staff and when, what to buy and when, what to prepare on site. And then we go about and functionally automate those processes. So we look to help them perform better through better decisions, but also then look to automate hundreds of hours a week on tasks like making rosters, making orders, prep lists, and things like that. So that's our business model. And I suppose what I'm here to talk to you about today is the fundraising journey. So the approach that I took or that we took and what worked for us didn't work for us. So I said, I have a snippet here. Obviously, we closed our round in April with some great partners like Excel, Playfair in the UK, obviously Calvary in Germany as well. So some great partners on board. But I will caveat that was after lots of no's. So that's to be expected when you get out in this journey is if you hear the first 10, even 20 no's, that shouldn't stop you. You should get a reason for the no's, right? You should understand why they're saying no. If it's could be a myriad of different reasons that we can cover in today's presentation. So a couple of questions that I always try to push people to ask themselves before they decide to go out and raise funds. So if you're early stage pre-revenue, as Shahryar talked about, or wherever you're at, is what type of business do you have? That really affects the type of capital you can access. For example, if I went out to market with Mad Egg versus Nory, the interest levels are obviously going to be massively different. The ability to scale that business, the ability to grow it for investors to get returns is hugely different from what would be seen as a lifestyle business for a restaurant or something that's enterprise SaaS, right? Enterprise AI, which is a pretty hot space. So you have to ask yourself that, what business are you really in? How attractive is this going to be for an outside investor? What's your attitude towards growth and sharing control? If you're going to go down the VC route, which we'll touch on today, you better be expecting that you're going to want to grow fast. That's the reason what these guys want to come on board. But you're also going to be given input into decisions that you make from the get-go, and you need to be comfortable with that. If that's not something that you're comfortable with, then it's something you should be asking yourself whether this is the right route for you. Obviously, what stage of development your business is in. So if you're completely pre-revenue, what kind of traction can you show? Can you bootstrap your way to some meaningful traction? Because I definitely think you should. For Nory, for example, signed up our first 60 customers from a pitch deck before a product, right? You need to be able to show people what you're about to build, and it's always a good idea to try and get them to potentially buy it or sign up for it before you spend the money on building it. The risks that are involved and the returns that are expected, so you need to be aligned with who you're looking to take on to your business. So if they have a 5-year return cycle, they have a fund size, you're going to have a return model for how much money they expect to get. So that's to kind of make sure you're aligned with your partners that you take on and the rate at which your business will consume your cash, your burn rate, right? So if you're the big question, how much money do you need? you need to be clear on, or be able to model that out. What are you using the cash for? How far are you going to get when you get to that point or that milestone? Are you going to go again? Are you going to be profitable, broke even? Are you going to look to do another round? What then? What's that round for? What's the outcome that you're looking to get? It's not just about going out to raise a bunch of money, have it on your balance sheet and feel great about yourself. You obviously want to have a milestone that you're looking to achieve and to be able to evolve the business. So, and finally, underlined and in bold, which is most important, what's your end goal? What do you want from this journey? If you're going to start or launch a VC backable business, it's going to be pretty all consuming and encompassing. So you want to make sure that you're up for that for the next 5 to 10 years, and just make sure you're aligned with your own personal wants, because it's always in the media and the press a lot these days, but you just want to make sure that that's for you before you go out on this journey. So you still want to proceed, great. One of the first questions is to VC or not to VC. So Shahryar mentioned around angel investor groups or venture capitals. There's obviously a bunch of different ways you can get capital or equity or sell equity out of your business, but it's pretty important that you decide which route that you want to go to, obviously when aligning your business. So people can assume taking individuals on board is a light touch way to go, and they won't have much input, and VCs are big scary people who are looking to kick you out if things don't go well. I think that in retrospect, you can have a bad route either way. With the wrong individual, I think VCs are at least very practical and very open what they're looking to achieve from a business. So both are great, and if you can have a mix of both, fantastic. And a lot of people will go and look to get some strategic angels or people on board who can help advise them, particularly if they're first time, and then look to get VCs later in an investment process. That's what we did, and that kind of fits into the next slide. So find your Sherpa. So this was my first VC fundraise, or first time engaging anything like this. I was starting from a complete standstill, being a solo founder as well. It's not the easiest place to be. It's pretty lonely. So one of the first people we signed up or got on to cut us a check was a great angel called Mark, who had invested in over 100 companies around the world, great ties to huge investment houses and great VCs all around the world. He really bought into what we were doing, but showed us the ropes for what we needed to do, how to set up a correct process, how to get people interested, what terms we should be looking at, what notes we should be looking at, what funds we're investing at what point, etc. Just a lot of things that are quite difficult to understand, and there's just so much information. So if you can find someone, it doesn't always have to be an investor. If it's someone else who's gone through the process that can give you some time, just look to speak to them, get an understanding of what the journey entails, how you should structure it from the get-go, but really speed things up, because it can be a pretty long process if you don't know which direction you're going in. So set your terms. This isn't always the easiest thing to do, but have an understanding of evaluation if there is one. If there's not, and you're running with like an uncapped note or something, just have an understanding of how much you're willing to give away from your business at this point. I think it's super important, particularly if we're going into a negotiation, and be comfortable with that. So there's obviously a multitude of different notes or instruments you can use. It can be convertible loan notes or safe notes. I think for early stage, my advice would be, well, I know we went with a safe note, but it was preference over agreement for equity rather than loan notes, but it's whatever fits your business. But main piece of advice here is have an understanding of a realistic valuation at this round or at the next when you might liquidate, and just have a clear and comforting understanding of how much you're going to give away in this round and then the future rounds for your business. From the get-go, choose your vertical wisely. So apples and oranges comes to mind. So as I said, if we're a restaurant, not even beyond this chart in terms of VC money going in, but if you're looking in a space, fintech, AI, ML, there's obviously a bunch more capital going into these spaces because they're at the beginning of an S curve. So if you can align your business model within something where you can see capital is flowing pretty freely, it's obviously not to be dishonest about it, but that's something that you need to think wisely from, because it's going to be a lot easier to raise capital if you're in a space that's busy than in a space that's not being looked at. And why you might want to create a blue ocean or a new investment market, it's not the best for an investment process. So find your audience. So you know your vertical, you're sitting in the fintech space. Now you need to find out who's going to listen to you, who's going to be attracted to you, who's going to want to invest in you. You can use your Sherpa if you have one. If you don't, the funds are pretty clear online. You can get a bunch of who the top seed, pre-seed, Series A investors are for whatever vertical, for AI, ML, for fintech, for automation. Look to hotlist these guys, then look to see where they are, how active they are. You can go on Crunchbase, you can see how many investments they've made in the last 12 months, 18 months. Are they cutting checks? That's important. You don't want to waste your time. Then you want to list them out to go, where are they in their fund life cycle? If they've got 10 years to invest and they're at year 8, they're going to be likely to pressure you to exit pretty quickly. If they're at the start, they might be cutting more checks, or maybe not, right? It's just to understand where businesses are at. If you can get someone who's early in their fund life cycle, if they're active, they're back in your space, that's a big green light for you to want to engage. So obviously on that engagement piece, if you can get a referral or get a warm entry, for sure, that's great. That's usually the easiest way to cut through the pack. If you can't, there's people screening inboxes in these firms as well. If you're compelling enough in terms of your story, there's a chance that they'll engage to speak to you. So then FOMO for the win, right? So you'd assume that VCs don't talk to each other. They look to keep deals to the side and try and engage through a process. It's probably the opposite. A lot of them kind of vet their inbounds off each other, and this can be good signaling or bad signaling. What I mean by signaling is 1 or 2 VCs are really interested in you. You can bet your bottom dollar that 20 more are going to be in your inbox to want to speak to you too. So if you can kind of rustle up a bit of competition, that's always good to get a process done quickly, because everybody wants to close the hot deal, right? And where the market's at the moment, there's a lot of capital flowing. So it's a piece of advice that I definitely lean on. And then finally, be the hero. So like for your own deck, your deck is your movie, your deck is your story. Make it personal, make it compelling, and try to add a bit of personality in it, but also add why your business is going to be the next great thing, or already is, and why you're the person of the team to deliver that. And you can do that with a bit of personality. I think if you've got 90 seconds to catch people out, that's a super important piece of advice. So going from here, I thought it'd be practical just to kind of do a 90-second walkthrough of what our deck looked like, what we put into it, and what we sent around. So it's kind of following on from what Shahryar talked about, from the problem to the solution to the team to the investability. So I'll run through it pretty quickly. I'm not going to give a massive overview of each slide in detail of what we're doing, but just to give you a flavor, and I'm happy to share some of these slides after this if you wanted to use them yourself. So obviously Nory, here we are, what our big bold strap line is. So you want to get them hot early. If you only want to look at one slide, you want to have some sort of traction and some sort of credibility. So we had our accelerator win, our private beta launch, the growth that we had, the locations we signed up, and the funding we've already closed in that couple of weeks. So immediately they're on the front foot. Frame the story. What's the problem? Why should I care? You've got an industry, for us is obviously the restaurant space or the hospitality space. You've got some big names who aren't performing well. Why aren't they performing well? We're looking to change this, so get them interested. Continue to frame a story. Get some social proof in early. Obviously, domain expertise here through Matt A, having scaled that business from that approach. What's the how? What's the difference? How are we going to define a new reality for these businesses? So we showed our change in decision making through our process. We broke it down into more detail in terms of what the product is going to do. You get some sexy UI for the win to show them that you're focused on a great looking product. What does the world look like after you guys have engaged? So this is an average size customer. What's the tangible benefits they're going to get from using your product? Why are they going to buy it? So got for us direct labor savings, reductions in waste, top line sales, big changes in EBITDA, etc. Right? Prove it. So it's great to say approve it. So one of our first early kind of pilot customers who saw a 20% bump in their net profit over a couple of months, and that needs to be someone you can call on if they want to speak to, because they will want to speak to them, and a bunch of them, right? So have something there. And everyone loves traction. So you've started out, you've got a bit of a team together, you've started with a presentation, you've got some sign-ups, you've started to launch a product, now you've got a waiting list, brands are getting bigger, there's more interest. You want to run through that. What's the market opportunity? So here's your TAM. Why is it huge? Why is it investable? So you want to have some workings for this. So for us, we would have used obviously our kind of target geographies for the products. We would have even went on TripAdvisor, taken like what are fast casual, fast food businesses by 1 million population in each of the key cities we were aiming for, multiply by our price points, and you've got your TAM, SAM to go into that. So you want to show that it's a massive market. Obviously, if VCs, they need to be able to return the fund if they see something that's not large enough, but also not realistic. So it's a bit of a balance there, but super important for those. Your financials, as Shahryar said, you want to have at least 3 years there. So what are you going to do? How are you going to get there? break it down into numbers of customers. How you're going to get those customers is the next one. So you go to market, what channels you're going to use, if it's top down, bottom up, or partnerships, how you're going to attract them, where you want to sit. You want to be in the top right, not the bottom left, if you're going to do some sort of competition matrix. What's your business model? How are you going to make money? How do you charge people? What's your exit comparable? Because this is an investment. They want to make a return. Who else is in your space? How much are they exited for? What can they conceivably get from investing in you? Who are these guys and why should we listen to them? Here's your team, here's your advisors in the space, and always ask, right? So how much are you looking for? What are you going to do with the money? Don't say we want $2 million to because you want $2 million, right? Where is that going to get you? What stage of the business? What's your revenue milestone? What's your customer milestone? Are you ready for the next funding round? How many people are on the team? What's the product going to look like? So it needs to be a conceivable use of funds. You need to be able to, one, model that, two, present that. So that's kind of the final one there. So I know that was rapid, quick. I wanted to kind of just breeze through it and leave time for some questions coming up. But that was kind of my journey and advice I have. As I said, happy to share most of these slides. We're also hiring for a bunch of roles across products, engineering, and business development. If you're interested in having a chat, you can ping me at connor@nory.ai, or you can see the jobs that are open there. So hopefully that was valuable for you guys. I'm looking forward to answering a couple of questions.
Conor, thanks for that. That was excellent. I mean, your 90-second, it's like literally you picked Shahryar's brain and you put all the good points of what makes a good deck into it, because it had its traction, it had your TAM, it had your SAM, you had all those details, it had where you were in the market, what you were going to do with the money, great team slide, experience, and it was slick, it was fast, there was an energy to it. I know you have had 90 seconds, but there was still, even in the process of it. So there's a couple of questions for you. You kind of, I wanted to ask you, because it is interesting, how did you meet that early investor? Lots of people kind of waste your time and they give you yeses and nos. And how did you meet that early investor that introduced you and opened the doors? And what advice would you give people to meet those type of individuals?
Great question. So for us, I suppose we were kind of lucky that we won the pitch competition for the accelerator, got some inbound interest, and he was one of the inbounds into us initially, built a relationship. He didn't invest probably for the first 6 calls, but he was actually helping before then. So it was kind of a symbiotic relationship there. Other advice I would give is finding other founders or CEOs that you might have access to, who you can speak to. They tend to have people in their networks. They'll try to give you advice. It tends to be much more of a amenable relationship. It's not transactional from the get-go. You can go straight to angel networks and things like that, but it's going to be more of a sales meeting from set one. So if you can find someone like myself or somebody else who's gone through a process, who you have in your network, it's probably the best step to take first.
Now, had you a co-founder as well? How did you meet your co-founder, or how did you kind of bring together your team?
So no, I didn't have a co-founder, and that was obviously a difficult step at the start. You read everywhere that if you don't have a good kind of balanced founding team, people aren't going to invest in you. I think my background in domain expertise kind of helped that, and having scaled the business previously, but we would have got complementary team really early. So from the first, after the accelerator, during the accelerator, balanced it out with a head of engineering, some great product people, some fantastic engineers in the team. So really quickly had a really early founding team, which was great. So advice there would be is you don't always have to have a co-founder, but you need to have a balanced team. So like Shahryar said, you can't be too heavy in one area of expertise.
I must unmute myself. From the early fundraisers that you did, and some obviously went well, some didn't go well, what key learnings can you take from the early, approaches to VC, early fund rounds that you were involved in, to then now being successful and raising that in the most recent round? What was the difference between you now and the difference between you then?
Confidence, first one, probably, for the process. When you go in to your first bunch of meetings, super nervous. It's not a situation you might have been in before, to sit across the table from people, or a webcam from people, and be asking for big sums of money, right? That's not easy for anyone. So to be able to tell a compelling story while confident was super important. during the process as well, we just started to evolve over as a business in terms of more traction, more pull, more positives, and kind of the business itself, the message became clear, it became more of an actual business opportunity than something that was an idea. So that's why my first question was, can you bootstrap or get through that process? I think we went too early at the start. And then I think after 2 or 3 months that we were able to really kind of flesh it out and have a compelling end to end for a story really helped.
And just a couple, I'll wait for a few more questions to come in. I wanted to ask you is what are you guys working on at the moment? You said you'd raised the 2 million. What's your kind of plans? What's the next stages? You briefly went through it, but give us what you're kind of doing next. What are you working on?
Yeah, so we're focused, UK and Ireland focused at the moment, and we're using the funds to obviously build out the products and the team. We hit our next kind of revenue milestone. So the people we brought on board, thankfully, are kind of continuing investors. So they go from pre-seed to Series B or C. So the idea is if we can work together to achieve our milestones, we'll look to do obviously be in a better commercial standpoint, but look to do a significant Series A to go into the States in the next 12 to 18 months. That's kind of our next stopgap.
And the team at the moment is how many, and how you mentioned careers, what are you looking to expand to?
Yeah, so end of April it was 5, it's now 23. So it's been a decent ramp up, and we have 10 open roles at the moment. We'll probably close the year around 35 people, 35 to 40, and then double again next year. Yeah.
There's a question here from Raja. How do you balance between technology and the management part of entrepreneurship? So I think it's more of a kind of a question. How do you kind of balance this? That's what she's kind of getting at.
Balance technology and management.
She kind of asked, how do you balance between the technology and the management part of the business? And that's how she phrased it. But I'm kind of saying, I kind of expanded it, like how would you, could you any advice on managing that, kind of a startup, growing the business and the kind of the technology?
Okay, for sure. Yeah, I think like it's not easy, right? So I think it's your team. So like it's having the right people around you, the right people to own parts of the business and really drive it forward. If you try to do everything, you're just going to sink. So you need to, like, as a CEO, you tend to be quite growth focused, outward looking, being the sales side, but obviously being a solo founder, you have to be initially the very product focused, because that's coming out of your head into other people's brains. But spend a lot of time really getting a great team around us, people who are confident in our roadmap and achieving what we're trying to do. So you're confident that the train's going the right direction. It's up to you to kind of get more outwardly focused from a management level, for sure. Bringing in people on your team who are confident and comfortable to lead and develop people, because in any industry now you're only going to be as good as your people, and there's so much competition for fantastic people in technology space.
I just had a question. It was one thing that Shahryar, I'll bring Shahryar in back in this as well, to probably both of you. Shahryar just mentioned, that with startups, a lot of it is sales and knocking down the door. And some people don't actually ever think of that. They just think, oh, I'll grow the product. But it's kind of a broader question. What have you kind of both learned about yourself through this journey? What skills you had? What skills you've kind of got to work on? But in general, what have you learned most about yourself, Conor? And that's to you, Shahryar, as well. Whoever wants to go first through this journey.
You can go first, man.
Sure, a lot. Actually, this has been, as you mentioned, I did my MBA, and once I finished it, I thought I know everything. It was only when I started at Capital Pilot that I realized that how much practical knowledge I lack. Being agile and flexible is one key thing that I learned. You need to be able to adjust to everything, because things can change overnight. You need to pivot. You don't necessarily need to fall in love with your product, because eventually you might face a hurdle that makes you change something fundamental in your proposition. So that's definitely something. My soft skills have improved, because it's at the beginning, it's all about building relationships, whether sales, fundraising, selling your product, socializing about your product, attending events, putting your face out there in the market. So it's all about people skills and building relationships, building partnerships, selling the idea to investors, selling the idea to clients, selling the idea to your employees. Make sure they're all in kind of on the same page as you. They share the same vision and passion for the service, for the company. So those kind of soft skills have definitely been improved in me. And also you get to learn about everything, because you need to do sales, marketing, product, some tech. Even if you're not a coder, you need to understand it. And you need to have this holistic view of everything that's going on in the business and in the market. HR, hiring, you name it. I mean, you basically need to do, at the beginnings at least, you need to do everything by yourself until you find the relevant people to help you with that.
I agree. I think soft skills are super important to being able to get what's in your head out in front of people and get people aligned and to buy into it, because as soon as you have people who can help you out in the areas you're not particularly strong with, the faster the business will go. So as quickly as you can get to that point. Big thing for me was understanding what I wasn't good at and getting help and getting support there quickly, because you always try to overcome obstacles that are just could be better placed in somebody else's hands.
You're muted
there.
Oh, I'm still muted. So just one more quick question, and then, and this is only something I always ask people, and then I'll hand over to Erin to tidy up, to finish the event. What was the best advice that you were giving during this process? I mean, has anyone given you advice, a VC that you've taken on board that really hit a nerve with you? Or what kind of best advice you've received? Or could you give some really good kind of snappy advice to our budding founders as well?
Go ahead.
Is it for me? It's for both of us, or? Well, we routinely give advice to founders, but also we've been the recipients of lots of advice as well. Probably, I mean, the one thing that I can talk about is, again, validating your idea beforehand. Just don't sell something that there's no demand for or you haven't validated, because the more you get the deeper you go into that product, the more you develop, the more difficult it becomes to change on the route. So before you do anything, make sure you have a product or service that is needed in the market and is validated, and then go on and spend your time, effort, energy, and money building it in full capacity. Before that, you run the risk of disappointing yourself down the road.
And Conor?
Yeah, 100% agree with that sentiment. I was going to say, now you have a hair on fire problem, you're solving a real problem before you go too far. It's a great book called The Mom Test we were given on the first day in our accelerator. Recommend people to read. Don't ask your friends if it's a good idea. Go out and try sell the idea first, right? And you'll know if it's good or not.
Yeah, it's different selling something to your friends or close ones, or than selling to someone who's actually need to take the wallet out and put the card number and buy your product. As soon as that part comes into play, the dynamics change. So make sure there's someone wanting to buy your service.
Well, look, I thank you both for your time. Just a quick note, can both of you share your LinkedIn profiles in the chat as well? But look, firstly, great talk, great advice, great to see both of the journeys and people who have gone through it. And look, I want to thank you both for your time, and because I know you're both very busy, and I think everyone on the group will have appreciated all your nuggets of wisdom. So I'm going to hand it over to Erin, and hope to see everyone soon.
Thank you. Oh, there I am. Not much from me, just to say, as Jack said, thank you both for sharing your time. I appreciate how busy you are. So much good advice in there, and I know people are really keen to connect. And thank you to everyone who attended. I also appreciate that, because I know we all have a little bit of Zoom fatigue and are really looking forward to getting back in person. My team's posted some contact information in the chat if you want to connect with us or have any other questions, and we will send the slides around and the presentation by the end of this week. And we really hope as a team to be back to doing something in person with alumni before the end of this year. So until then, stay safe, and thank you so much again for everyone's attendance and for everyone's time. Thank you.
Thank you.
Thank you. Bye.